So imagine discovering that, like the leftover fryer grease from your local fast food joint is suddenly more profitable to process than an actual barrel of crude oil.
Right, which sounds completely absurd when you say it out loud.
It really does.
Hmm.
But today, we're looking at a financial report that, frankly, proves the global energy landscape has just been completely terraformed. We're doing a deep dive into Valero Energy Corporation's second quarter 2026 earnings.
Yeah, and when you crack open a document detailing over $44 billion in quarterly revenue.
Which is just a massive number.
Right, $44 billion. The goal isn't just to read off the top line numbers. Our mission for this deep dive is to look under the hood. We need to figure out exactly how Valero is taking both heavy crude oil and literally used cooking oil and turning them into billions of dollars in pure profit.
Exactly. And, just to jump right in, looking at the digital ticker tape and the global refinery map we pulled up for the sources today, it's obvious this isn't just a simple story about, oh, oil prices went up.
No, not at all. It is, it's really a masterclass in operational efficiency and strategic pivoting. Management is showing this incredibly aggressive understanding of when to squeeze a physical asset for every single drop of value.
And when to just completely walk away from it.
Exactly, walk away entirely.
So let's lay out the sheer scale of these results first, just so you, the listener, can really grasp the magnitude of what we're dealing with before we get into the operational mechanics.
Yeah, the headline numbers are wild.
They really are. So net income attributable to Valero stockholders hit a staggering $3.7 billion for just the second quarter of 2026. In per share terms, that's $12.62 per share.
And you have to compare that to the same quarter last year, right? In
Yeah.
Q2 of 2025, they reported $714 million in net income, which is $2.28 per share.
Wow.
So you're looking at net income multiplying by more than 5 times year over year.
It's just an ocean of capital. I mean, adjusted net cash provided by operating activities was $4.5 billion in just a 90-day window. And they aren't just sitting on it. They are aggressively moving that capital. Valero returned $2.6 billion directly to stockholders this quarter alone.
Which is huge.
Yeah, it represents a 59% payout ratio of their adjusted net cash from operations. And that's alongside a regular quarterly cash dividend of $1.20 per share.
But the crazy part is, even with all that money flying out the door, to the stockholders,
$1.9 billion in cash and cash equivalents. And get this, a debt-to-capitalization ratio of just 11%.
and see, that 11% figure, that dictates their entire strategy.
How so?
Well, in the energy sector, which is, incredibly capital intensive by nature, carrying that little leverage while holding nearly $8 billion in cash, it just gives management immense strategic flexibility.
Right, they aren't losing sleep over interest payments.
Exactly. They aren't stressed about servicing debt at all. They are focused purely on optimization.
Okay, but I have to push back a little here on the idea that this is all just, strategic brilliance.
Mm-hmm. Sure, go ahead.
Because when I see numbers this big, my first instinct is to ask, well, is this just dumb luck? I mean, looking at the data tables in the report, the average market reference price for Brent crude oil jumped from $66.59 a barrel in Q2 of last year to over $97 a barrel this quarter.
Right, a massive jump.
So is management actually executing something special here, or did they just get bailed out by macro tailwinds? Because honestly, it feels entirely possible that they just parked their massive infrastructure in the middle of a global supply crunch and, waited for the market to pull the trigger for them.
It's a fair question. And look, the macro environment is undeniably a massive tailwind. You can't ignore $97 oil.
Right.
But generating $44.4 billion in quarterly revenue without letting your costs completely spiral out of control, that requires a level of granular discipline that is actually super rare when commodity prices spike like this.
Because usually companies get sloppy when the money's rolling in.
Yeah, exactly. CEO Lane Riggs points directly to what he calls excellent operations and commercial execution across all 3 of our business segments. And the proof of that execution is really in their capital investments.
Right. Let's look at those numbers.
They spent $350 million this quarter, but only $290 million of that was for sustaining the business.
Wait, I want to break down what sustaining the business actually means in this context, because they're running this globally distributed physical infrastructure, right? They're processing 3.0 million barrels of highly volatile liquids every single day.
Yeah, it's a massive, massive physical footprint.
So how on earth do you keep the maintenance and compliance tab for an operation that size under $300 million.
It really comes down to how they manage what the industry calls turnarounds.
Okay, what's a turnaround?
So turnaround isn't just like routine weekend maintenance. It is a planned massive event where you take a hyper-pressurized industrial city completely offline.
Wow, yeah.
You're inspecting miles of pipes, you're replacing chemical catalysts, upgrading safety systems, all of it. And historically, when oil prices are sitting at $97 a barrel and cash is just flooding in, the temptation for management is to just let those turnaround budgets balloon.
Because they feel like they can afford it.
Right. But Valero keeping that sustaining capital number tight means they're capturing the macro margin without inflating their own operational costs. That discipline is the actual mechanism translating top-line revenue into that $3.7 billion bottom line.
Okay, that makes sense. You mentioned they're keeping a tight lid on capital expenditures. Yeah. But when you look at their traditional refining segment, maintaining that massive 3 million barrel a day throughput, the margins are what really jump off the page to me.
Well, absolutely.
The refining segment generated $4.5 billion in operating income this quarter. A year ago, that exact same segment made $1.3 billion. Their refining margin per barrel of throughput nearly doubled.
It went from $12.35 in Q2 of 2025 to $23.62 this quarter.
Meaning every single barrel they push through their system is generating almost twice as much raw profit. And that's before we even factor in depreciation and operating expenses.
Yeah, it's incredible efficiency.
But how are they physically extracting that extra value? The report mentions this, $230 million capital investment for the St. Charles FCC unit optimization project. And that's on track to begin operations in the third quarter of 2026.
Right, and this is a perfect example of how they allocate capital smartly, because they aren't out there building entirely new refineries from scratch.
Oh no, the environmental and regulatory hurdles would make that nearly impossible today.
Exactly. Instead, they're taking a highly targeted bet on a fluid catalytic cracking unit, or FCC, at an existing Gulf Coast facility.
Right, and for you listening, a good way to think of a barrel of crude oil is like a raw log. An FCC unit is essentially this massive chemical sawmill. It lets them chop that log up into higher margin pieces like premium gasoline or petrochemical feedstocks, rather than settling for cheaper, heavier outputs like asphalt.
That is a great way to visualize it. An FCC unit uses intense heat and these specialized chemical catalysts to basically crack the long hydrocarbon chains of heavy crude into those shorter, highly valuable chains.
So for a $230 million investment, they're fundamentally upgrading the chemistry of their existing infrastructure.
Exactly. They get to squeeze higher margin end products out of the exact same physical barrel of crude oil.
Okay, but while they're optimizing on the Gulf Coast, they're taking a completely different approach elsewhere.
Yeah, the West Coast is a different story.
Right. The report details the situation with their Benicia refinery in California. They completed a phased idling and basically full cessation of operations there by April 2026.
Yep, shut it down completely.
But what really stood out to me is that shutting down that refinery actually triggered a $44 million favorable benefit to their cost of materials this quarter.
The LIFO liquidation.
Right, due to a LIFO inventory liquidation. Can
Yeah.
we explain the mechanics of that? Because it really highlights how accounting interacts with physical, real-world reality.
Absolutely. So LIFO stands for last in, first out. When a refinery buys crude oil continuously, they account for the cost of the fuel they sell based on the most recent and usually more expensive barrels they just purchased.
So the older, cheaper barrels of oil that they bought years and years ago just sit on the balance sheet at their historical cost.
Right. Theoretically, they're just sitting at the very bottom of the massive storage tanks.
Okay.
And they just stay there indefinitely during normal day-to-day operations. But when you completely shut down a refinery like they did at Benicia, you eventually drain the tanks to the very bottom. You're forced to physically liquidate that old inventory layer.
Oh, I see. So Valero suddenly sold oil that was valued on their books at historical, much lower costs into today's super high-priced market.
Exactly. That physical draining of the tanks is what created that $44 million accounting benefit on paper.
That is fascinating. Okay, but we do need to talk about the physical realities and risks of operating these facilities. Because on top of the Benicia closure, they had a fire at the Port Arthur refinery in March 2026.
Yeah, that was a notable incident.
And it cost them $15 million in repair expenses. Now, a fire in an oil refinery sounds basically apocalyptic.
Right.
How is a literal explosion barely a blip on their financial radar?
It really just puts the sheer scale of their operation into perspective. I mean, a $15 million repair bill is a massive industrial event for anyone.
Right.
But when your quarterly operating cash flow is 4.5 billion and you're sitting on almost 8 billion in cash, it is financially equivalent to like a homeowner with $100,000 in the bank paying $200 for a broken window.
Wow.
It's just absorbed instantly.
But taking a step back here, I mean, they completely shut down a West Coast refinery at Benicia. They absorbed an industrial fire at Port Arthur. How does shrinking your physical footprint and taking actual damage lead to record-breaking overall refining profits?
This is where that concept of strategic pruning comes into play. You see, the refining business isn't just about massive volume. It's really about the profitability of each specific molecule you process.
Okay,
The West Coast regulatory environment is notoriously strict, right?
very much so.
And the compliance costs there can make margins highly volatile. So by shutting down Benicia, which, by the way, is now being decommissioned and managed under their corporate and other segment, so it's not dragging down the actual refining segment's operating metrics.
Clever accounting there.
Yeah, they basically eliminated a low-margin drag on their broader fleet. They are essentially raising the batting average of the entire company by cutting a high-priced, underperforming player.
That makes a lot of sense.
Okay.
They took an asset impairment hit previously, but going forward, their fleet is much leaner.
Exactly.
However, as fascinating as all this traditional refining optimization is, the most shocking year-over-year transformation in this entire document happened in Valero's low-carbon segments.
Oh, without a doubt.
The renewable diesel segment, which is driven by their Diamond Green Diesel or DGD joint venture, posted an operating loss of $79 million in Q2 of 2025.
Right, they were losing money.
But this quarter, it posted a massive $717 million operating profit.
That is nearly an $800 million swing in a single segment in just 12 months.
It's unbelievable.
Huh.
The sales volumes averaged 3.8 million gallons per day, but the underlying margin is the real story here. Last year, they were making a microscopic 22 cents of margin per gallon of renewable diesel. This quarter, that margin exploded to $2.52 per gallon.
It's just a totally different business now.
And we see a similar story in their ethanol segment too, right? Operating income jumped nearly sixfold, from $54 million last year to $318 million this quarter, with production averaging 4.7 million gallons a day. Ethanol margins per gallon more than doubled, from 52 cents to $1.15.
Yeah, and to go from 22 cents to $2.52 in renewable diesel margin, that is a leap you almost never see in a mature commodity market. It really requires a perfect macroeconomic storm colliding with established infrastructure.
I really want to understand the mechanics of this because to me it feels like an arbitrage machine. It's like running a recycling center where the city pays you to take away their trash and then buyers down the street pay a massive premium to buy it back from you as a luxury good.
That analogy is spot on. I mean, if we look at the average market reference prices in the data tables, we can see exactly how this arbitrage spread materialized.
Okay, let's break it down.
It revolves entirely around the gap between the cost of their waste inputs and the soaring value of the end products and the environmental credits.
Let's look at the revenue side first then. The market price for the actual physical fuel surged. Right, the New York Mercantile Exchange, ultra-low sulfur diesel, jumped from $2.16 a gallon last year to $3.74 this quarter.
Right. But the physical fuel is only half the story, because renewable diesel isn't just a fuel, it's a vehicle for regulatory compliance.
Right. This is where we need to explain the mechanics of biodiesel renewable identification numbers, or IANs.
Yes, the RINs are crucial. So a RIN is essentially a digital serial number attached to a gallon of renewable fuel. Government mandates require traditional refiners to blend a certain amount of renewable fuel into the national supply.
And if a refiner fails to do that,
If they fail, they are legally obligated to buy RNs on the open market from someone who did, just to prove compliance.
and because Valero is producing so much renewable diesel through the DGD joint venture, they aren't just meeting their own blending obligation. They are generating this massive excess supply of RINs they can just turn around and sell to their competitors.
Exactly. And the price of those RNs almost doubled year over year, going from $1.09 to $2.12 per RN.
So it is a massive secondary revenue stream for them.
Oh, absolutely. And on top of that, you have the California Low Carbon Fuel Standard, or LCFS, credits.
Right.
California basically assigns a carbon intensity score to fuels. Because renewable diesel is made from waste products like used cooking oil, which would otherwise just sit in a landfill and emit methane, It has a highly favorable, sometimes even negative carbon score.
Meaning it's actively pulling emissions off the ledger.
Exactly. So
Yeah.
turning it into fuel generates incredibly valuable credits under the California system. And those LCFS credits rose from $52.36 to $68.34 per metric ton this quarter.
Wow. So they are getting paid significantly more for the physical fuel itself. They're selling the federal RIN compliance credits at double the price, and they were capturing a massive premium from California's carbon reduction mandates.
Yep.
But an arbitrage machine only works if your input costs don't rise at the same rate.
Right.
Okay.
Which is the true genius of their model right now. While the end product value in all those credit markets were just skyrocketing, their feedstock input costs remained incredibly stable.
What were those costs looking like?
Well, U.S. Gulf Coast used cooking oil only went from 56 cents to 82 cents a pound. And fancy bleachable tallow, which is basically industrial animal
That
fat,
sounds delightful.
that went from 56 to 84 cents a pound.
So the cost of acquiring the raw waste materials, the used French fry grease from restaurants, the tallow from agricultural processing, it went up maybe 25 or 30 cents a pound.
Right.
But the value of the diesel and the environmental credits they sell on the back end exploded by dollars per unit.
That spread between relatively stable waste input costs and surging environmental and fuel output prices is just pure profit. Valero built the 1.2 billion gallon per year diamond green diesel infrastructure specifically to capture this exact kind of mechanical arbitrage.
And it paid off.
Huge. When the macro environment shifted, their net cash from operating activities caught the windfall. They generated $389 million just from the joint venture partners' share alone.
You know, if you were looking at the global energy transition right now, this analysis completely shatters the narrative that we have to choose between fossil fuels and green energy.
Oh, completely.
It proves you don't have to choose between being an old world traditional refiner or a new world clean tech startup.
Right, because the narrative is so often framed as the zero-sum game, where investing in one means completely abandoning the other. But Valero is demonstrating that you can execute both concurrently and at a massive scale.
Yeah, they are leveraging their legacy petroleum infrastructure and the immense cash generation of $97 Brent crude to basically fortify their balance sheet.
Yes, and then they use that stability to fund these highly profitable low-carbon ventures. I mean, they are literally taking the profits from refining heavy sour crude and using it to turn millions of gallons of ethanol and used cooking oil into a massive economic growth engine.
And doing it with incredible financial discipline, as we saw with their tight capital expenditure controls.
It really leaves us with a fascinating dynamic to consider.
What's that?
Well, with the Benicia refinery shuttered and traditional refining margins soaring, Valero has proven it can do significantly more with a smaller physical footprint.
Right.
But look at the math on the renewables side. If processing used cooking oil and animal tallow is suddenly yielding $2.52 in margin per gallon compared to the pennies it used to make, are we entering a bizarre new era of energy economics?
That's a great point.
I mean, are we approaching a reality where agricultural waste and restaurant byproducts become as strategically vital and as fiercely competed for as a barrel of West Texas intermediate crude oil?
When the grease trap behind a fast food joint becomes a highly sought-after global commodity, you know the energy landscape has fundamentally shifted. And that brings us to the end of our analysis of Valero's second quarter. Keep digging into the data, keep questioning the mechanics behind those margins, and remember, whether it's heavy crude or cooking oil, understanding the underlying arbitrage is how you truly understand the market. Thanks for joining us for this deep dive, and be sure to follow the show for our daily earnings coverage.